Hello, everyone. Welcome to the True Potential Do More With Your Money podcast. My name's Jamie Sexton. We're on episode 53, so just over a year of podcasts now. I'm joined by a star panel. I think you recognise a few of them. We've got Mr. Neil Johnson, George Bell, and Earl Glasgow. And we're also joined by a special guest today, Gerard Duxbury, one of our wealth management partners. Jed, I think we know everyone else. Do you want to just tell us a little bit about yourself and how you were True Potential?
Yeah, I started working with True Potential in 2012. I've been a financial planner since 1994, and I suppose my daughter would be disappointed if I didn't say I'm a fellow of the Personal Finance Society.
Oh no, we've got two fellows because Earl's a fellow as well, so got two on today.
Oh no, yeah, I always wanted to be a financial planner from the age of 19. I did maths at university, trained for 4 years as articled as a training chartered accountant, and then came into financial services, and now I suppose I have around about 300 clients, and I really enjoy it, love it.
It's Jed, what's the from your point of view? We're back in lockdown now. We've been locked down previously. How have you found it with your clients in terms of adopting a Zoom method or Teams or whichever you've been using? How have you been engaging with your clients?
Well, it's took a little while to get used to it on both sides, on mine and theirs. But I'm certainly used to it now, and so are they. I don't find it much of a hindrance. Certainly saves the planet fuel wise, and it can be quite frustrating with some of my older clients, as you might imagine, talking them through getting the technology sorted. But overall, it's been time saving because we're not traveling. So from a business perspective, it's not been a hindrance.
Yeah, I think from a business perspective, there has been some positives of forced change, which is that, as you say, the fact that you don't have to travel and you'll have a meeting via these sorts of technologies. I think that's been quite a positive, and I'm not sure we may go back to some face-to-face types of meetings, but I think this could be the new norm moving forward, unless everyone gets out of lockdown and just is dying to see people. But we just don't know. Thanks, Jed. So we'll just go over to George now, just our standard comedy. George, we've obviously got the announcement of the new vaccine this morning. So I think that's number right. 4, built in our very own Middlesbrough, I believe it's going to be produced. Yep. So the Northern vaccine, we should call it. But I don't know if that'll have any effect with the markets this morning, George. But if you could just give us a little bit of what's happened this week and what you expect.
Yeah, absolutely. I mean, it's been a very unusual week, and I'll explain a couple of reasons for that. If we look at global equities, we'll put this into context. Global equities pulled back around 2% on the week. In the UK, you had similar levels. Mid-cap names outperforming the larger cap FTSE 100 slightly there, but in the US, again, similar levels, down around 1.7%. The Nasdaq, which is more tech focused, outperforming, similar levels across Europe and in Asia. Bond markets offered a bit more support. You had yield levels on government bonds, which came in. UK gilts moved in from around 0.3% to 0.28% on the 10-year. So moves in. That's positive for prices. In the US, you had sovereign yields move in from around 1.08 to 1.04 there. So a little bit more muted the activity within the bond markets, but for a multi-asset portfolio providing that support, you actually had positive returns in US corporate bonds over the week there. So we need to have the two sides in context there when we think about a multi-asset portfolio, which our investors, of course, do hold. Currency markets, you had a little bit of US dollar strength over the week on a trade-weighted basis. So one of the indices which Jeff will refer to on morning markets is the Dixie index. So that was demonstrating a bit of strength, reversing some of the trend which we've seen over the last few weeks there. And you had sterling up against the dollar from around 1.36 to 1.37. I think a key area which caught investors' attention over the week was the activity which we experienced in the equity markets on Wednesday. One particular stock drawn attention there was Gamestop. Now, Gamestop is a US high street company who sell video games, they sell consoles, a bit like a Blockbuster type model in the UK, or Game is the company which is still around, very much focused on the high street, a business model which has become dated, and a lot of analysts were anticipating this. It became apparent that a number of the large hedge funds in the US were actually shorting this company's stock. It was expected around 30% of the stock which was outstanding there was held by hedge funds. And when a hedge fund shorts a stock, essentially what they're doing is they're borrowing shares from other investors. They pay a fee for this, and they sell those shares on the market. So, for example, they sell those $10 a share. They then have to return those units to the investor at some point in the future, but they wait until the share price falls to, say, $5 a share. Then they buy them back. They give the borrowed shares back and return those to the original owner, and the hedge fund pockets the profit there. So that's essentially how shorting a stock works, and that's what they were doing. The reason for that, well, the hedge funds were expecting the companies to struggle financially. If we look at how this really caught attention, it was discussed at a number of forums, and so you had a number of non-institutional investors, essentially probably people who are not working at present in reality, trading on mobile platform accounts. So they were buying shares, they were buying call options to drive the price of the stock higher. And this really caught the attention of people like Elon Musk, the chief executive of Tesla, who really added wind to the sails there with his tweet. So the stock, which was listed on the New York Stock Exchange, it's up over 1,000% year to date. It did 351% from Monday to Wednesday close. So it was a real stick it to Wall Street trade, with the option buyers on the retail side really driving that price up. The reason it creates turbulence in other markets, because we're just focusing on one name there, there was a couple of examples over the week where they did hold traded on there, is because if you think about the hedge funds, whilst they're short stocks such as GameStop, on the other side of their book, they're long other areas of the market, other stocks which they do like. So if they have to cover the losses in stocks such as GameStop, they've got to sell the positions which they are long. So it creates that volatility within the broader markets, which you did see. So the markets weren't necessarily immune, despite just seeing the movement in that one particular stock. You had a bit of a bounce back in trading yesterday after you had the restrictions imposed on the trading of those particular stocks. You had the S&P adding around 1% back up there, and you saw volatility come down. But I think it really did just highlight the importance of diversification within a portfolio. It also highlights the importance of active management and the ability to avoid a number of these traps and navigate around them. It was also an interesting week for central banks. We had the Federal Reserve out on Wednesday maintaining their support for markets. You had interest rates to remain zero bound, asset purchases to continue at the current rate, so buying $80 billion of bonds a month, $40 billion of mortgage-backed securities. That program isn't going away anytime soon. It will be there until the Fed feel that they're meeting targets on inflation and employment. So the concept is really to create favorable lending conditions to stimulate growth and provide liquidity to the market. And that continues to be a theme across central bankers. I discussed on Morning Markets last Friday the decision from the European Central Bank as an example there. You also had the IMF report. The IMF report increased forecasts for global economic growth from 5.2% set in October to 5.5%. This is for 2021. And China and the US were too forecasted to see stronger growth come through. China being a country which emerged from a very strict lockdown in the early days very well, and the only developed market to actually post a positive economic growth return last year. The US, on the other hand, has remained very much open, but have been stimulating to a huge extent. We've got an additional $1.9 trillion on the table with the democratic package there, which is expected to come through, though the timing is a bit challenging at present. As a team, I think one of the things which we have really been focusing on is the recovery will be uneven, and we've been discussing that on many levels. Different regions will resume activity levels at different paces. It's something which we monitor very closely with our managers in the positions which they have, and it's very much dependent on access and rollout of the vaccine. You gave an example there from this morning, Jamie, but the IMF was citing the challenges of this and citing the challenges which this could present within Europe and the supply chain constraints which we've seen widely discussed this week, and also the emerging markets. But one thing that is sure is we are moving closer towards targets of governments in terms of vaccine rollouts. There's a number of countries there which are leading the way. It's all about getting the supply chains to operate as efficiently as we can, and the additional approval of vaccines is very much key to that. I'm just trying to focus on a few areas here, Jamie, which we've really been focusing on. But I think just one thing I'll finish off with is perhaps looking at the earnings of companies, which is really where analysts get their guidance. It's really the what's really happening on the ground in terms of companies. And we've had a number of earnings reports from Europe. We've had a number of earnings reports from the US. Around 170 of the 500 names in the S&P 500 have reported. And generally what you're seeing there is positive surprise. So reports are beating analyst expectations. Expectations were for a bit of a decline in growth, but there's a number of firms which are surprising to the upside. If we look at the firms which have been supportive or sectors which have been supportive, you've seen a lot of upside surprise in financials and technology. So some of the names which we hold on a direct basis there through managers such as Goldman Sachs or Close Brothers, names such as Apple or Microsoft, what you're seeing there is revenue growth quarter on quarter of around 17%. And if you think about Microsoft, it's quite an astonishing figure. That's 14 consecutive quarters of double-digit growth, which they're seeing coming through, and it's translating into their earnings as well. You're seeing earnings growth coming through at a similar rate in Microsoft, for example. You're seeing earnings growth of around 30%. So it's been a really interesting week in terms of movements which have been stimulated by platform accounts and retail traders, central bank policy, vaccine development, but also earnings as well. So we've got our next round of manager calls coming up. So we're sure we'll have some interesting discussions on there, which we'll bring back to the podcast.
Brilliant. Thanks, George. It's interesting. I thought the days of a tweet changing the market were over when Donald Trump got his Twitter account to take it off. But
it's certainly a different environment. It's something which we've been looking at, and I think a lot of it, as I say, is to do with the fact that you've got more people taking an interest through individual trading accounts.
Yeah, definitely. Brilliant. That's great, George. Thank you for that. Very interesting. So today's podcast, just sort of getting back to the theme, we asked clients questions that they may have. We had a lot of questions regarding IHT in terms of inheritance tax and how you can work with that, and more about later life planning. So we thought we'd designate a podcast and a question session to this specifically. So we've got quite a few questions from some clients. We've also got some specific areas that we think we should cover. So Jed, I'm going to start with you, if I may. So we had a question from Melanie, which was very clear. It was, how can I reduce IHT on my estate? So I think just from when we say IHT, inheritance tax, I'll try and not use the abbreviations. But can you just explain from a high level to clients, especially what is inheritance tax, and how should you consider it when you get into sort of later life?
Well, it's a tax on the value of your estate on death, and it's quite a penal tax with a rate of 40%. But I find with my clients, I have a very long-term relationship with them, and it's something that you have an awful long time to address it. So there is the saying that it's a voluntary tax because you don't have to be in a position ultimately on your death where your estate is in excess of the allowances that you have, and you have a single person has a £325,000 allowance. If they own their own home, then they have a residence nil rate band of up to 175,000 as well. So that's 500,000 potentially. And if they have a partner or a spouse and they have the same, then potentially you've got £1 million worth of assets you can pass on. And you've got your pensions too. Anything that you've got left in your pension funds, you can pass that on. So the allowances for the majority of the population are generally reasonably sufficient, and it is a choice of what assets you want to hold on your death, and there's plenty of time for most people to plan to reduce it or eliminate it, and it is, it's, as a financial planner, it's an interesting long-term game to play with your clients, which is let's manage this away if you want to. To what extent do you want to get rid of it? How important is it to you? What kind of priority is it? And obviously, as people get older and or their estates are growing, it becomes an increasing priority. And obviously, for when people have a reduction in their expected longevity, so maybe some bad news health-wise, or the partner might become ill or die, and these are all times when inheritance tax is going to increase for people as a priority, as it will do over time as the amount of years that you expect to have left reduces.
Yeah, thanks, Jed. I think it's one of these things where the value of people's property has tended to bring them in line with it. It was something where property value goes up potentially, and that's why we saw the property nil rate ban come in, which has helped towards that. I think that's the key asset that people sometimes potentially forget about in terms of being included in your estate. And I think it's interesting you mentioned it. It's from an inheritance tax perspective, it's 40% from a tax basis. And Neil, just coming across to you, I think looking at COVID, it's cost us a significant. It cost the country billions, if not more, in the future. We'll see the true cost at the end of this pandemic if we do, or if we get there. The budget's coming up, and there's been talks from the Chancellor of changing different different tax rates and which tax rate will be effective to actually cover the cost of this. And kind of just looking for your view, for our viewers, really, just to understand what your thoughts are.
Well, you're right, Jamie. I mean, the government's borrowing more in a month than they would in a full fiscal year in the past. So it's a dramatic increase. And as the pandemic extends, you can see month on month, this is layering up. So yes, budget day, 3rd of March. So we're looking forward to that. I think there's been so much speculation and trailing of potential changes. And this has started a lot earlier than normal. The back end of last year, obviously the recommendation coming in to the Chancellor saying, well, look at capital gains was one particular aspect which certainly piqued our attention, because there's an element of, should CGT, capital gains tax rates, be more aligned with income tax rates? So instead of being 10% for basic rate taxpayers, it is currently, and 20% for higher rate taxpayer, should that be aligned up more towards 40% or 45% for higher rate taxpayers? And I think the issue with CGT, I think from my perspective, this is if people are investing and then perhaps selling investments at certain times because they require that income, or if they've built up a business, and a bit like our business, if we've got a lot of shareholders, a lot of the staff, for example, are shareholders, and then ultimately some of those shares are sold. You look at an investor, they've already paid tax on that money they're investing. They've paid income tax, it's a net amount, they then invest. If they then realise that, there's another tax on top, which I think everyone would accept it's fair to levy a tax in that way. But when you start saying, well, instead of 20%, it's 40%, 45%, it does seem excessive, certainly from my viewpoint, to start saying you'd bring that level much higher. I think the other thing to bear in mind on capital gains tax is is the Laffer curve, where clearly there's an inflection point. The higher the taxes go, the more people actively try to avoid them. So there's definitely a question that if at 20%, I think people are prepared to pay the tax. If you increase that to 40 or 45%, a lot of people will go to great lengths to avoid that level of tax. So, it changes behavior, and they may find perversely that even if they double the tax rate, the tax take could actually go down. And that's certainly what a lot of tax experts we've been talking to have been saying to us, that will probably hold true. So there is that, one of the headline figures there, I think, was this idea of capital gains tax being dramatically increased, which would be very unwelcome. We'll have to see what he does. I think the other areas, the government seemed to be hamstrung by their December 2019 manifesto, when they were saying, well, we won't increase the headline tax rates, across particularly things like income tax, and they're sort of sticking to that. But I think income tax, they'll probably look at things like, well, not increasing the thresholds, not increasing the band. So over time, as earnings increase, though earnings haven't increased much this year, of course, so that doesn't hold so much this year. But in general, if you fix that, then your tax take will increase on income tax. You've got national insurance lurking in the background, although I don't think they'll do much with that. But the direction of travel, Jamie, seems to be, higher paid individuals, wealthier individuals. Can we levy more tax? And obviously this other idea, which does seem, certainly the press reports I've been reading over the last couple of weeks, this idea of a wealth tax does seem to have drifted away a little bit. There was a proposal saying for wealthy people, 1% of your assets each year for 5 years, which, isn't even a sort of one-off tax. It's a recurring one. And again, I think, I'm hoping that's been sort of scotched within HMRC and the Treasury, where they say, well, people will just try to avoid that. Even if we try to backdate it and pursue, people will just go offshore and not pay that. So I think, it's a balancing act, isn't it, for the Chancellor, because he's going to have this big overhang of debt. Currently, that's being financed at historically extremely low interest rates, but ultimately, it's still a major issue in the long term. But in the short term, you don't want to hit people, you don't want to hit businesses. I mean, the other things I read at the weekend, this idea of, for self-employed people, well, this perception that somehow self-employed people are paying less tax or getting away with something, which clearly they're not, and I think, this idea of, let's, increase taxes on the self-employed, perhaps because maybe they're paying a bit less. It's a real misapprehension, that one, I think, and self-employed people, a lot of those people with the small businesses, they're the people who are going to drive this recovery. So don't start hitting them with extra tax at this stage. So I think, Jamie, on balance, I'm hoping it's going to be a relatively status quo budget, nothing too dramatic, but perhaps more of a signalling of a direction of travel that says, well, over time, certain taxes are going to have to be at a higher rate. The other way to do it, which was something that Sunday Times economics editor suggested quite a while ago, is, you almost ring fence this slice of the debt, a bit like a war debt. We only repaid the Second World War debt in 2006 when Gordon Brown paid the last one away. And in an environment where you get a bit of inflation over time, which George would say that may see some return to elements of inflation in the economy, then you've ring fenced this debt, and over time it becomes less onerous. So that certainly was an interesting idea. I haven't seen that taken up by many commentators, but you almost treat it as a separate item within government debt, and just deal with the normal fiscal calculations, and then you've got this big item to deal with in the longer term. So that's what I think, Jamie. I'm not I haven't got a crystal ball here, and we've got a couple of meetings with the big accountants over the next couple of weeks to see what they're guessing and what they believe will happen. But I think there's quite a lot up for grabs, and we just hope there'll be nothing too dramatic. Certainly the capital gains tax thing, I think, would be a very negative move for everybody.
Yeah, I think it would definitely be taken negatively, Neil. I think what we'll most likely probably do a session or a podcast on as we get closer to the budget with the likes of yourself and David, and just give views on that as we get closer and we understand more information on it.
Yeah.
Right, okay, just skipping back to the questions again. Earl, I'll give this one to you. We've had a question from David, which is basically, what happens to my money when I die? So obviously we're aware of, every time I look at a client, I advise them to take up a will. I think just giving an understanding of actually what will happen if you don't have a will and why it's so important.
Yeah, very important, Jamie. Look, if you die without a will, the way I explain it to clients, things just freeze, and it's very hard now. Even with a will, I've dealt with 2 estates in the last 3 years, and it's certainly not a very quick process. Right now, what a will does, it allows the executors and the solicitors, obviously, to get into probate and to distribute after they complete a long list of tasks, like get your inheritance tax calculated first, to make sure the revenue's sorted out, and even pay your income tax and pay a list of bills. And once all that's sorted out, right, then they can distribute what the will says to the beneficiaries. If you don't have a will, then it's a bit more complex. They have to go and search and make decisions themselves. If you want to distribute assets outside of a will, then the main 2 things for me is you need to use trusts, which means that you've gifted the thing already. You've got a trustee to look after the asset, and they're going to give it to the beneficiary, so it sits outside of the estate, so you can get that money or that asset to the individual that you're nominating. But the good thing about a trust is you don't give them control right away. You can keep control of the asset, and then they can get it when the trust kicks into place. And the other thing, of course, is pensions. Pensions sit outside; they don't go into your estate either. So, the trustees of the pension scheme, I think Neil's the trustee of the True Potential pension. He deals with this every day with Mark and Brian, where when people pass away, they have to decide the nomination of beneficiaries and make sure who gets that money. But a will is very important. Without a will, it's very, very complex. Even with a will, it can take a long time. I've seen these things take 6 months. The worst one I dealt with was 2 years, because it was quite complex. But without a will, it's not good at all, because they don't even know. And then you have the usual things in a family, which is you may see the whole family break down and have a bit of a discussion about, I thought I was getting that, etc.
Yeah, it's really important. I think actually that you made a point there just about the nomination form for the pension. So you can on your website complete a nomination of beneficiary as clients for your pension. And Neil, I think it's coming to you as a trustee. I know we talk about this quite a bit. How important is that?
It's absolutely vital, Jamie. I mean, the main evidence that the trustees will always go on is the expression of wish, which is the form within the pension. And when you set it up with your financial advisor, they'll make absolutely sure, that you have that expression of wish. But, if you've brought other pensions across over time, you might have a range of pensions. Just make sure, contact your advisor, or as you say, Jamie, you can go on our website, check that you have got the expression of wish in place. And once the trustees have that, it's clear. Keep it under review as your circumstances changed. I just changed mine recently because I redid the wills last year, and one of the things we looked at was if you're, in future. I mean, I've got 3 kids at the moment. My expression of wish was 100% to my wife, and one of the things I put in is I've actually put 97% to Heather, to my wife, and 1% to each of the kids. And if over time, if let's say I did pass away, when that comes to trustees, if Heather wanted to say, actually, I don't need those funds, it can go straight to the kids. Because they're named on the expression of wish, the trustees can just take that direction straight away. And, we can sort these pensions out in very short time scales. Conversely, I mean, sadly, in recent months, we have had more death cases. It is quite sad, arising a lot of that out of COVID. And we do see cases, people don't have an expression of wish, they don't have a will, and it's a bit of a detective forensic exercise to go back through the family through the solicitor if they have one, through the financial advisor, and say, what was this individual's wish? And as Earl's touched on there, you get cases where the family may disagree. And if there's nothing written down, there's no expression of wish, and there's nothing in a will to go on, it's very hard to make those judgments, and that can take a lot of time. And some of the family may ultimately miss out. So I can't reinforce it enough. The expression of wish on all your pensions, legacy ones, just get that together, have a chat with your advisor, message them, and make sure that's all in place, just in case, because for the trustees to say we can just act on that immediately, and whatever you wanted to happen can happen straight away, right through the probate. But without that, it's a big problem.
Yeah, great. Thanks, Neil. As I said, if you can do this via your site, but if you wish to look at that in a bit more detail, speak to your advisor or give us a call, we'll be happy to help you and show you how you can do that. Jed, just going across to you, when I speak to clients, a lot of the sort of, as they're getting older, they actually like the idea of gifting some of their money so they can see their children benefit from it, rather than wait until they're dying. It's basically giving on inheritance. So from a gifter perspective, what's the rules around that, and in terms of what are the options if clients wish to do that?
Well, there's quite a lot of misconception amongst clients. I find people are always saying, I believe I'm only allowed to gift an amount about £3,000, and people are getting mixed up with the annual gifting allowance for inheritance tax, which says that if you gift £3,000 to anybody in a year, that it's gone from your estate, and in the event of your death, it won't be added back. It's gone. That's your allowance. But people get mixed up with that and think there is a limit on how much you can gift. The UK is quite different from most other European countries in that there is no limit on how much an individual can gift to another person outside of their estate, that being the children, or gifting further afield. Say if you were in France, there'd be a tax on the person who received the gift. Here, there isn't, and it's quite a big difference. I was talking just last week to a UK domiciled person in Singapore, and they hadn't really realised just how much scope there was to gift money away and reduce their estate that way. But it's not just about reducing their estate. It is about actually identifying assets that you're never going to need in your lifetime, and then just making that sensible decision and saying, what's the point of me keeping hold of this if somebody in the next generation, if my daughters are can make use of this, then the sooner that you do it, the better. Because if you were going to invest it, say, then if they do the same, then that investment growth is outside of your estate. They can also just, if they were taking income from it, you can see them benefit from it. And so gifting is a really good idea, and I absolutely applaud it, and applaud it doing it at the earliest opportunity. I've talked there about outright gifts. People might choose to make gifts into trust. Say, for example, not everybody wants to gift a significant amount of money directly to, say, young people or children who are in a relationship that seems like it might break down, and in that case, that's where you use a trust, and you might gift money into a trust, and in that case, you'll still retain control over the assets, and it'll be up to you to decide when they're distributed. So gifting's very, very important. You can also make gifts on the marriage of your children and grandchildren, and those will also fall outside your estate for inheritance tax. But otherwise, any gifts, whether they're into trust or whether they're directly to your other members of your family, they'll be added back to your estate if you die in the next 7 years, and they'll be included in the inheritance tax calculations. So that's why it makes sense to do it sooner rather than later.
Definitely. Thanks, Jen. I think you mentioned a couple of times there about trusts, and Earl spoke about trusts as well. And I think it's important to people to understand that trusts give you that option to really specify what you wish to do with that money at some point. And there's some, I'll maybe take this across to you, Earl, because they can be used initially where you're saying, as you said, you don't want to give the money directly to someone, but you give people that option to say, well, I want to set it as an income, or I want to make sure that individual gets it on debt, or I might, so there's many options there. I don't know if you want to just give us a little bit on that.
Yeah, but look, what a trust enables, somebody sets up a trust, they can get somebody else to look after it. So I've been a trustee several times, and even one of the estates I dealt with lately, I forgot that I was a trustee. But the gentleman set up a whole of life policy or a term assurance with an insurance company, and actually that was the first thing that paid out, because it was paid out in death. It was in trust, which was a very clever thing to do. And the family, the son, got the money, as soon as the insurance company paid it, which was, I think, some 5 months ahead of the estate actually getting wound up and getting the rest of the money. So it shows you the speed of the trust. And that was a simple life policy that said, on death to be 200,000 paid. Now, if that hadn't been written into trust, Jamie, that would have formed part of the estate, and the solicitor would have took that. And actually, when you go back to what happens on death, that it was a bit nerve-wracking, that one I dealt with, because there was a lot of assets held by the gentleman, and the wife, he had a lot of stuff in his own name, not many joint accounts. And actually what shocked her was that actually even the joint tenancy of owning a bank account or owning assets jointly, right? The solicitor stepped in, froze the bank accounts, and that was it, right? So when you've seen the power of joint tenancy and the power of the use of a trust that can put things outside of a state, not even in terms of inheritance tax, but just basically, getting money quickly. You can't emphasize, proper planning, speaking to somebody like Jed and understanding, how do you set things up properly in trust? What's the benefit of joint tenancy on bank accounts or assets or residence? We'll talk about long-term care in a moment, but, making sure the house is in joint names. But, the trust just sits outside the estate and means that if you want something to happen, you've got trustees to look after it. So even on death, there's somebody there to look after and distribute the trust assets. And it's quite simple. There's all loads of different ones: loan trust, discretionary trust, bear trust. We could spend a whole podcast on that and put people to sleep. But essentially, you want to set it up. You put people in charge of it who are the trustees. So on a pension, it would be Neil. We could corporate trustees look after that. And then you just nominate your beneficiaries. And the trust kicks in when you want it to kick in. So if you want to give them something, but you want to create a space of time before they get it, because you don't think, years ago we used to set up simple policies in the company I worked for, saving plans. There were children policies, but they were bare trusts. Basically meant you just invested in something and they didn't get into the routine. And it was a great way of doing it, so they couldn't take control until that time arrived. Some of them wanted to do it to 21 or 22 because they thought at 18 they still wouldn't have enough sense, but it was essentially set up in a trust. So lots of planning and lots of reasons to talk to Jed about not just him taking the money off you, but taking it off you in the right way and setting it up, to make sure that things work out the way you want.
Yeah, I think that's it's definitely important, especially when you get into that later life. Just most people on death want to ensure their assets are, that person that they leave behind is kept well, and they get the assets in a timely manner. And I think that's why these sorts of things, thinking about them now, and it's not, it could be thinking about them early, but it's actually really important just to sort of plan that out. And speaking to a planner about that is is something that we would highly recommend. Right, we've got I'll have one more question here. We obviously see, we discussed this last night, but we have in terms of a horizon, in terms of care costs, and it's something that comes in clients' minds quite a lot in terms of paying for care in the future and how that's facilitated. I suppose, how would clients prepare for this from your point of view? Hopefully you've had a few. I know your wife's heavily involved in this sector.
Yeah.
So just giving some understanding of how clients would potentially prepare for that.
Well, look, even at the moment, we can see the advances of science. We're hit with what's basically a bug, quite severe bug. We've got a pandemic. And here we're coming out with vaccines. My GP once said to me, people are living to their 80s now, and that was basically down to him. I think he was taking a lot of credit for that in terms of medical, advances in the last 30 or 40 years. Probably the biggest change, in Northern Ireland is, years ago you never seen a thing called a nursing home. There was the odd old people's home, and they were called that, and the people in there were maybe 60 odd, so it's not looking good for us, except for George. But you have two types of homes, and if you get old and you don't have people to support you, there's a lot of these out there. So you've got residential, on average is £600 a week. And the other thing is, right across the UK, it's all different in how things are assessed. So on average in the UK, it's £600 a week. And if you need a nursing home because your activity, your ability to look after yourself, you need more help, you've got nursing homes, which is, £800 a week. And there's one round here that the wife's been telling me a lot about, which is starting to give me concerns, where actually you can pay £150 a week more, and apparently it's got a jacuzzi and a bar and a lot more social entertainment. So it's £950 a week. So I wish you would stop talking about it. But look, if you've got assets, you'll be expected to pay for it, right? And there'll be, she works in the social care sector where they're assessing these things all the time. And if you've over £23,250, you'll have to fund that out of your assets. If you're below 14,000, then you'll get help from the authorities to do that. When you get into a residential or nursing home, you give up all your income, your pensions, any of your state benefits. You're allowed to keep about £23 a week in personal expense allowances. But in saying that, a lot of people that get into nursing homes, I think the average I've read is they're in there maybe 12 months, right? So, it's not where now some people stay in a lot longer, but it's not that you're going to go in there. But, if you talk about inheritance tax at 40%, if you're in a nursing home at £800-900 a week and you tot that up, there's 40-odd thousand a year, right? That's going to deplete into your income. And the thing people worry about, Jamie, is their home. Mm-hmm. Will I have to sell the house? And again, the safeguards there, if it's a joint tenancy and somebody's living in it, or you've got disabled children or relatives or people over the age of 60 that are dependent on you. So, it's a bit of a minefield in terms of means testing, but you can make do planning about it, and mm-hmm. speak to somebody like Jed who'll plan that and distribute the assets, etc. Now, the thing you can't do, and I'll say this, you can't, once you think you're going to go into a residential or nursing home, you can't simply start giving the assets away at that point, because there's a deprivation of assets, and they'll take a dim view of that and maybe demand the assets back. So it's one of these things where, you need to sit down and plan it, like your inheritance tax, your trust planning, and work out what you're going to do about it. The fact of the matter is, if you need it, you need it. And I'd also say about inheritance tax, you need to live. You spent your life, accumulating money to be comfortable in retirement, and you need to be comfortable in your last days as well. So it isn't about giving away all the money and then you end up in poverty. It is about saving hard, accumulating money, and then when it's needed, it's needed. If you're going to have to pay, well, then get one at £950 a week where there's a bar and a lot of social entertainment, and have a really good time in the last few years.
Well, that sounds like potentially Anne maybe trying to get you in there. I don't know if that's a good thing or a bad thing.
I don't know. Well, at the moment, I think she's trying to get me back to the Marriott in Newcastle. She's had 9 months of me at home, which is the most she's seen me in 20 odd years. But she's moved on from the Marriott to the nursing home, so it's not looking good for me.
She'll definitely need a break. Brilliant. Well, I think, to be honest, we've had some very good questions there. Thank you to everyone that's brought the questions. That's wrote into us and after that. But hopefully, we've given a little bit of taste of what you can do. And I think just to take back to speaking to your advisor early about these things, if you have concerns and you want to put plans in place, is really important. I think hopefully, if you do want to speak to your advisor about them, give them a shout. If you want to speak to us, give us a call, and we'll be happy to sort of put plans in place and help you and support you. We're here to help you with these things. Right, well, just in typical style, just before we finish off, rather than ask what people are doing at the weekend, what I thought I'd do is that we've probably got for the fittest people from True Potential on the podcast today. And what I would like you to do is just give us your top fitness tip for being in lockdown. What are you doing? And I think I'm gonna be able to guess what it is. But we'll start with you, Neil. What would you give to our viewers in terms of a top tip for keeping fit during the lockdown?
I think try and get out of the house and go for a run or a walk. Get some air, because on occasion I've made the mistake of just being in the house several days running, and for all I've got a exercise bike, it's not the same. So for me, I think it would be try to, and you can do Zoom classes and all that. For me, I think you get a lot of value out of going out, and of course right now, when you can actually see somebody else, you can go for a run with somebody else, and that kind of covers my whole social life as well. It's about all I've got, but that would be the tip for me, Jamie. Yeah,
good. We've actually, just so people know, we do have some fitness classes on our YouTube page that people can use from Dauntless Fitness. It's actually it was some excellent things that we did right at the start of the pandemic and continued, which is paying a local trainer to do some videos for our staff, and we've shared them with clients. But they're fantastic if you want to have a little look at them. If you want to have half an hour of pain, it's worth looking. Jed, you look a man of fine fitness. I've witnessed you on your bike in Italy or around Lake Garda before on Instagram. So tell me what do you do to keep yourself fit?
Well, every Saturday I go to Aldi. I time myself going around to see how fast I can do my shopping. See if I can beat my personal best.
That is a challenge, mate. That is a challenge, getting around Aldi in a specific time.
It is. It's very challenging. And aside from that, we will get out and do a nice walk at a weekend, and that burns a good few calories. But like Neil, getting out, doing the odd run, even just watching Mrs. Duxbury is exhausting, to be honest. That seems to burn a lot of calories. She's out every day. She does an awful lot of exercise. So I can't light a candle to her. She does about 5 times as much as me.
Yeah, it's definitely. I'm the same. My wife is on these HIIT classes a lot more than I am. Earl, I spoke to a client in your town about a year ago, and he said to me he knew you because basically everyone knows Earl Glasgow in that town, and he says you're the running man. You're the man that he sees running with the headphones in. Is that true?
Well, not as much as it should be, Jamie. I think, one of the things I've noticed in this lockdown is, whilst this digital technology is good, it's not uncommon to do a 10, 11 hour day because it's just too easy to communicate with people on Zoom. So you tend to get into bad habits, that I need to get up the running. But I'll tell you what I did do, or I got Santa brought me a Fitbit smartwatch. Well, actually, I have to tell a lie. I got it for Father's Day and only put it on at Christmas. But it's actually quite good because it scares the life out of you how little active you are. And I would say to anybody, you can get these things for £100 odd. You slap it on your wrist, it tells you your sleep pattern, your heartbeat. I'm worried it's going to tell me something I don't want to hear someday. But when you get to 4 o'clock in the day and you've only moved 3,000 or 4,000 steps, you get home at night, and then the wife says to you, what have you done today? Oh, and then she says, oh, you obviously been sitting around all day doing nothing. So actually having something that gives you a target, I found quite useful, because I have to think to myself, well, this is no use. I'm going to have to go for a run or a walk or do something. So actually, it's a bit of a nagging ant on my hand here, but it's quite good. I didn't think it would actually tick it as well as I have.
I've got the Apple Watch, and it's one of these things that I now find it, if I can't record it, it's pointless doing. So if I can't record me run because the Apple Watch is dead, then I won't do it, because I can't tell everyone that I've just done this run or prove it. And I think that's quite common. I don't think that's unusual. And George is nodding along there, because he's definitely he'll be on the bike this weekend, I would think. But what's your tip, George?
I think as Earl and Neil said there, you can easily spend a lot of time behind the screen in lockdown, and the day can very quickly disappear. So my tip is to get it out the way in the morning. So I like to wake up early, exercise, and you can see the daylight coming through. You can get out in the daylight for a short period of time. And then when I've finished, when I've shut the laptop down, I normally go for a walk at night. I think one of the things I noticed, I've got a Fitbit as well, and I bought it about this time last year, and how easy I was doing 10,000 steps a day, mainly just walking around head office, because you forget it's a big place, and you're up and down those flights of stairs more often than you think. So when I came to working from home, I realized just how few steps I was doing. So the Fitbit keeps me honest, and it's a target every day to try and hit that. I don't always hit it, and I try and, as Jed said, I try and make up for it on the weekend, whether it's getting out on the bike or going for a walk or a long run or something like that. But my top tip is get it out the way in the morning.
George, I don't know if I remember this rightly, but did you once go for a run at a night time and accidentally fall over?
Yeah, thanks for reminding us. I attempted the same route the other night with a brighter head torch and a little bit slower. But yeah, I had a bit of an incident which involved a steep hill, a dark lane, and a big pile of cow muck.
George, we'll not ask any more. I think we definitely know what's happened there. Well, thank you very much, everyone. Thanks to the panel. Thanks, Jed, for your first appearance. We'll definitely have you back. Thanks, everyone, and please subscribe and click like on the YouTube, and we'll see you again next week. Thank you very much.
Subscribing to the True Potential YouTube channel is quick and easy. Simply go to your YouTube app on your phone, type in True Potential and press the red subscribe option. You'll then be notified as and when new videos are released.